really have had very good earnings. So it's been a combination of potentially being oversold last year with fears of an imminent recession, as well as some fundamentals in terms of the earnings picture this year turning out to be even better than expected.
We welcome you to the 16th edition of Barnes Quarterly. Hope everybody's summer's off to a good start, and maybe you're finding a way to beat the heat that we've been experiencing here around Tallahassee. But Eddie Hatch is here with me, and he's just back off vacation. Eddie, how was tell us where you were and what you did.
Yeah, it was a great trip. Got to spend a little time with the family. We went over to the 30A area and spent some time at the beach, battling this weather that we've had. So we've kind of hit a few patches of rain and clouds, but other than that, we had a great week.
Well, very good. I too have been doing a little traveling. We looking for cooler temperatures, and we actually went down with my son to Argentina for about a week, and that's actually their wintertime down there, so it was a bit cooler than Tallahassee. And while there, did a little study on their economy. We think we've got bad inflation here, but Argentina's inflation rate was literally 100% last year. So their economy is struggling a little bit, but great people, great folks down there, very hospitable, and we had a great time. So as is our usual custom, we're going to be bringing Chris Zaccarelli on to talk about the markets year to date. We are in the midst of earnings season, so we wanted to touch on that. Obviously, the ongoing discussion of inflation, and then maybe some opportunities in the markets moving forward as we go into the second half of the year. So, Chris, how are things up in North Carolina?
Things are going well. We're having a pretty warm summer, but I'm sure that's the same for everybody. But other than that, can't complain.
Well, didn't you take the family up to Bar Harbor, Maine for a stay? You definitely got some cooler temperatures up there.
We did. We were up in Bar Harbor in Maine. We got to Acadia, got to see some really good public parks and hikes, and the temperature was about 25 degrees cooler, so that was very welcome given the summer we're having so far.
Well, outstanding. So year to date, the Dow Jones Industrials are up about 5%. The S&P index, which is the broader index of 500 stocks, is up about 18%, but the NASDAQ is up almost 36% year to date. What's going on?
So it's been a really interesting year, needless to say. I mean, that's a pretty big divergence in terms of performance for 1 year. But keep in mind, the performance was reversed last year. So, last year, the NASDAQ was the worst performing index of the three. And this year, it's the best performing index of the three. So to some extent, you're getting a little bit of a snapback from last year's concerns about an imminent recession, which so far have not happened, to this year, investors thinking, okay, if NASDAQ stocks, think the large cap tech names are down or were down as much as they were last year, given that we're not going into a recession, they're a little bit more of a bargain. So that's part of it. The other part is that those big cap stocks within the S&P and especially within the NASDAQ, which has a higher weighting of those big cap tech stocks, really have had very good earnings. So it's been a combination of potentially being oversold last year with fears of an imminent recession, as well as some fundamentals in terms of the earnings picture this year turning out to be even better than expected.
Well, very good. So obviously the continuing theme seems to be concerns over inflation. But talk a little bit about sort of where that discussion lies right now. Chances of inflation. We're in earnings season. Cover those items if you would.
Yeah, as far as inflation, clearly we had inflation that really went up a lot in terms of, the kinds of inflation readings we were seeing last year, around 9%, were the highest we'd seen in over 4 decades. And so that was very unusual and quite a change from the recent past, of which, for the prior 20 years to, let's call it, 2002 to 2022, or from 2001 to 2021, we saw inflation much, much lower, in the 2 to 3 range, if not a little bit lower than that. So inflation was a huge problem last year. And so the good news is that's come in quite a bit. We went from 9% down to around 3% on the headline. Currently, the core index, which excludes food and energy, which of course are very important essentials, but economists will look at, because it's a little bit less volatile a number, is around 4.8%. So whether you look at the core number, which the Federal Reserve looks at, or whether you look at the headline number, which we all feel and varies quite a bit month to month, we're still quite a bit above the 2% target. So the Fed is not done in terms of winning the inflation battle, but clearly things have turned in the right direction, with those 9% numbers being totally unacceptable to numbers getting a little bit better this year, although still a little bit higher than any of us would like. That's where things lie on the inflation side. As far as on the earnings side, we've had a pretty good year. As I mentioned, last year, a lot of people were concerned we were going to head into a recession, and you would expect in a recession earnings to go down quite a bit. Instead, we've stayed out of recession so far in 2023, and earnings have been pretty good. Single-digit increases, in some cases, 3 to 5%, in other cases more than that. But for the most part, earnings have been growing. And so that's a welcome change of pace, or change of circumstance from what we were expecting last year.
So for investors that are looking to put some money to work, what are the sectors that they should be sort of focused on, and why? And what are the sectors that they should probably be steering clear of? And you can include the discussion of fixed income or the bond market as well.
Sure. I mean, as far as, what we've been looking at, on the one hand, it seems like sectors such as consumer staples, utilities, even healthcare to some extent, which are considered defensive sectors, aren't necessarily as important right now, because if it turns out that recession is pushed off farther into the future, there's less of an urgent need to find those types of companies which will do well during a recession. Conversely, given how the economy is continuing to expand, and it seems like consumers are still spending, it looks like there's opportunities in the more cyclical sectors, those sectors which will vary more as the economy varies. So if you look within the industrial sector, within the financial sector, those are a couple areas that I think have good risk-reward characteristics in terms of them being relatively cheap because they sold off last year, as well as companies within those sectors having some pretty good earnings prospects, especially if we stay out of recession. On the fixed income side, I would say things are still a little bit mixed. To the extent that you're going into a recession or you expect an economic slowdown, those longer duration bonds, those bonds that have a lot longer until they pay off at maturity, would typically do better. And so given that it seems that recession is still a little bit ways off, those longer duration sectors aren't necessarily as attractive at this time, similar to the fact that defensive equity and stock sectors are not as attractive given the economic setup. But conversely, really short duration bonds won't necessarily protect you against longer term swings. So I would say somewhere in between. We're looking more kind of intermediate. So neither very long duration, which would do a lot better if we headed into a recession, or very, very short duration, which are paying high short-term yields, but yields that are not likely to last over an extended period of time.
One other sector just I'd like you to touch on, and that is the international markets. They seem to be showing a little life, and what's your thought on those?
So international is an area that we've talked about in the past, and I think it still has a lot of opportunity. And the reason for that is the U.S. economy and the U.S. equity markets have done so well this year. And so another one of the themes that we'll typically explore are that those parts of the market that have done the best, whether that's large cap tech or whether that's the United States versus the rest of the world, a lot of times that they're priced high because the fundamentals have been good, and that's the case for both of those areas. But on the other hand, obviously, the higher a price goes, the less price appreciation you may expect in the future, And at the very least, if things appreciate the same amount in those higher priced areas as those lower priced areas, at least on a percentage basis, an equal return from a higher number is a smaller percent return than an equal amount return from a smaller number. And so whether you're looking at opportunities going forward in terms of valuations being a little bit less stretched and a little bit less expensive, or whether you're just looking at the fact that price appreciation in and of itself can diminish your future returns, in both cases you may want to look in areas which are somewhat overlooked. And I would say international continues to be an overlooked area of the market, especially from US-based investors. If you look around the world, Europe has gone through a recession, or in some cases is in recession now, but they're starting to turn the corner and coming out of it. And the way markets look is they're typically forward-looking. So if you buy parts of the market that are in recession or just coming out of recession, they typically have more price appreciation potential than those areas where economic growth is already strong and that's already reflected in the price. For all those reasons, we still think international is a good place to look for future price appreciation.
Well, so last week alone, the stock markets were up anywhere from 3 to 4% just for that week. I guess two questions here. I mean, I think that sort of exhibits the importance of staying invested in the market, because if you were not in the market at that time, you would have missed out on 4% of whatever the market returns for the year. And so talk a little bit about that, but also, what if you had a perfect crystal ball that could sort of say what are going to be some headwinds for markets as we close out the second half of the year and enter into 2024, what would that be?
So to answer that first question, absolutely. The idea that you can time the market or try to determine, what everyone else is going to do in advance of what everyone else does is a very, very difficult thing. It's been proven time and time again, despite the fact that people feel that they can anticipate what the entire rest of the world will do. It's very, very difficult. And so in my, research and trying to really read as much as I can about the most successful investors in the world, make sure I'm listening to their podcasts, reading their books, trying to learn from the great people who have come before us, pretty much all of them to a T will talk about the fact that it's not necessarily market timing, but time in the market. And so they worry a lot less about whether or not the economic conditions are going to be very, very strong in the near future, or whether they look really, really bleak. They'll take that into consideration in terms of what types of things they're buying, so they don't completely ignore it. But for the most part, the idea of just going into cash, waiting for the right opportunity, and then getting back in, you'll see that most successful investors won't do something like that because they know how hard it is to anticipate. It's hard enough to anticipate what's likely to happen on a fundamental basis just by doing regular analysis of companies. But it's next to impossible to try to anticipate what millions of other people will do in the markets, whether that's looking 6 to 12 months ahead or whether that's looking 3 months ahead. So really, time in the market is your only way of making sure that you don't miss out on the kinds of rallies that we had last week and that we're seeing within this year. But that said, it's important to be diversified. Just like you never know when the market's going to go up 4% in a week, you never know when the market's going to go down 4% in a week. So a well-diversified portfolio across multiple asset classes, across stocks and bonds, can't protect you against losses. Nothing really can, but it typically over time will provide an experience which has less volatility than being 100% in any one particular asset class. And typically over longer periods of time will outperform what the typical individual will do on their own. That's all based on empirical evidence. There's nothing to say that in the future that relationship will hold, but that does seem to be the best course of action given that the future is always uncertain. Now, pivoting to your question about, what are the things to look out for the rest of the year, clearly inflation is something that's been driving this entire cycle. It's what's caused the Fed to be as aggressive as they have in terms of raising interest rates by 5 full percentage points in a little over a year, and what's likely to have them raise interest rates again at the end of this month, July 2023. They're going to probably raise interest rates another 0.25%. But after that, the Federal Reserve's actions in terms of whether they hold steady at their current rate of interest or whether they continue to raise interest rates will really depend on what happens with inflation. And as we mentioned earlier in this conversation, inflation, although it has come down quite a bit from the highs of last year, it's still not anywhere near the 2% target that the Fed is looking for. So it's really going to be path dependent in terms on whether inflation will continue to keep coming back down to that 2% target, or whether inflation will get somewhat stuck, or what they call sticky, in terms of coming down a little bit, but not coming all the way down. And it's really anyone's guess what's going to happen. And I think the Federal Reserve is going to try to take a cautious approach in that they're going to raise interest rates one more time. And then I think they're going to sit back and wait. They'll skip at least one meeting and possibly a couple more meetings. And they may even be done for the year after the end of this month. So all of those different situations that I laid out are really dependent on what happens with inflation. So I think that's the most important thing to watch.
Chris Zaccarelli of Independent Advisor Alliance are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.